Hey everyone, and welcome. Today we are going to crack the code on the single most important rule in all of business. I'm not kidding. This one idea is behind every single company on Earth, from the little coffee shop on the corner to the biggest tech giants you can think of. So, you ready? Let's get into it.
So, what is this big universal law? You might be thinking it's something complicated about profits or some secret marketing trick, right? Nope. It's actually a really simple, kind of beautiful rule about balance. And once you get it, I promise, it unlocks the secret language of how all business really works. All right, here's our game plan. We'll start with the golden rule itself. Then, we'll look at the core components. What makes it tick? We'll see it in action, check out how an owner's stake can change, and then wrap it all up. Simple as that. First up, the golden rule of business. You see, when you strip everything else away, all of business finance is just a balancing act. It's that simple. And this rule we're about to see, it's the formula that keeps everything perfectly, and I mean perfectly, level. And here it is. Assets equals liabilities plus capital. That's it. That's the whole secret right there. Just think of it like an old school balancing scale, you know? On one side, you've got all the stuff a business owns. And on the other side, you have all the claims against that stuff. And the most important part, this scale must always stay in balance. No exceptions.
Okay, so if we're going to understand this balance, we need to know what we're actually weighing, right? Let's break down the three big pieces on our scale: what a business owns, what it owes, and what's actually left for the owner.
First up, we have assets. Now, the official definition can sound a little academic, but here's the bottom line. Assets are all the valuable stuff a business controls. We're talking about the cash in its bank account, the computers, the delivery trucks, the inventory sitting in the warehouse, basically anything it owns that can help make money in the future. Next up, liabilities. Think of these as the total opposite of assets. A liability is just a debt. It's everything the business owes to other people. It's a claim someone else has on all that valuable stuff we just talked about. This could be a loan from a bank or even just a bill you haven't paid yet. And finally, we have capital. The fancy term is residual interest, which sounds complicated, but it's not. It's simply what's left over for the owner. Imagine this. If the business sold off all its assets, everything, and used that cash to pay off all of its liabilities, every single debt, whatever money is left in the pile, that's the capital. It's the owner's true slice of the pie. So let's make this super clear. On the left, you've got your assets, the things you own, your inventory, your equipment, your cash. This is your arsenal for making money. On the right, you have your liabilities, the things you owe, that bank loan that helped you buy the equipment, or what accountants call accounts payable, which is just a simple way of saying money you owe to your suppliers. Okay, enough with the theory, right? It's great to talk about it, but let's see this thing in action. We're going to watch how a couple of simple, everyday business moves affect our balancing scale. Okay, picture this. A brand new business is being born, and the very first thing that happens is the owner reaches into their own pocket and invests, let's say, $100,000 in cash to get this whole thing off the ground. And boom, look at how perfectly this illustrates the balance. Before, we had nothing, zeros all across. But look at the after row. The business's assets, specifically its cash, just went up by $100,000. But at the exact same time, the owner's stake, their capital, also went up by $100,000. The scale is perfectly level. You've got assets of $100,000 on one side, and on the other, zero liabilities plus $100,000 in capital. It works. All right, next move, transaction number 2. The business needs stuff to sell, right? So it buys $20,000 worth of goods from a supplier. But here's the key. It's on credit. They're basically saying, give us the goods now, we'll pay you later. So just take a second and think about this. The business got something valuable, but it also made a promise to pay. So on our balancing scale, what two things do you think just changed? Did you guess assets and liabilities? If so, you nailed it. The business's assets went up by $20,000 because it now has all this new inventory. But since they haven't paid for it yet, their liabilities, what they owe that supplier, also went up by $20,000. And look at that. The equation is still perfectly in balance. It's amazing. Now, I want to zoom in on that capital piece for a minute. It's not just some fixed number that gets set on day one. It's alive, it breathes, and changes with every single thing the business does, day in and day out. So how does the owner's stake get bigger? Well, there are two main ways. The first is pretty obvious. The owner can just put more of their own money into the business.
The second, and this is the goal of any business, is generating revenue, making money from sales. Every dollar of revenue earned increases the value for the owner.
And yeah, it works the other way too. Capital can shrink. This happens when the business has to pay for stuff. We call those expenses. Think rent, employee salaries, the electricity bill. It also goes down when the owner takes money out for themselves, which has a special name, drawings. Both of those things reduce the owner's piece of the pie.
Okay, it's time to put all of these pieces together. For our last section, we're going to look at one more transaction and see the whole story, from start to finish, told through our incredible equation. Okay, let's say the business has a great day and makes a huge sale, earning $45,000 in cash. Step 1. What happened? Well, our cash, which is an asset, shot up by 45 grand. Simple enough. Step 2. Why did it go up? Because the business earned revenue. And as we just learned in step 3, whenever revenue goes up, capital goes up by the same amount. So what's the end result? Assets are up by 45K and capital is up by 45K. The scale is level. See? It always works.
And this is the key thing I really want you to take away. Every single transaction affects at least two things. Always. You can't just add an asset without something else changing. It's a law of financial physics. It's the law of the balance. So really, you can think of it like this. Every transaction is telling a small story. We bought a truck. We sold a product. We paid an employee. But no matter what story is being told, the equation always remains in balance. I want you to just stop and think about what this means. By understanding this one little equation, assets equals liabilities plus capital, you now understand the fundamental grammar, the core language of every single business on this planet. That is an incredibly powerful thing to know.
So I'll just leave you with this final thought. Now that you can speak the language of business, what stories are you going to find hidden in the numbers? The next time you see a company report or even just think about your own personal finances, remember that balancing scale. What stories will you be able to read?